On today's Hashi, I'm discussing housing inventory for the week, the unemployment situation, or the employment situation, rather, report, and September housing market trends. Today is Monday, October 7th, 2024. I'm Byron Lazine, and the Hashi starts now. Welcome into the Hashi. Let me know which market you are tuning in live from. I am here in my Naples, Florida studio. I hope everybody is getting prepared on the Gulf Coast here in Florida and ready for, I think it's Milton coming this way in just 48 hours. So thoughts going out to all of the Gulf Coast peeps, and we'll see where that tracks to. Also, make sure that you are in BAMX, as we have a major announcement coming for that. It's going to benefit all BAMX members with Zudilio. That announcement is looming potentially as early as this week. So BAMX, you can use code HOT to get 10% off your BAMX subscription. Of course, if you have yet to do so, we are now within 2 weeks of BAM Mania. A week from Friday, we will be in Las Vegas at Circa for BAM Mania, the event of the year. BAMmania.com to grab your tickets. BAMX members, reach out to Jill at nowbam.com for your special discount in that. All right, we've got inventory here for the week, which we're going to jump into first. Then I want to recap on that jobs report from last week and also get into a mortgage lock-in update from realtor.com analysis. Okay, so first let's start with the good news first, because after Friday there's going to be some volatility again here in the real estate market, and we're coming into a time where we're 3-4 weeks away from this November election. Things are starting to get a little sticky. But let's go and focus in on the good news, that even at a time of year when we typically will see inventory start to decline, look at some normal years as an example, 17, 18, and 19. You're already on the decline on inventory at this point of the year. We're continuing. We are flattening out a bit here, but we are continuing, generally speaking, to move up as opposed to that bend down. We're 37% more active inventory than last year, according to Altos research. And we did pick up 3,000 plus more active inventory just last week alone. So going from 731,000 to 734,000. And think the start of 2020, January 2020, we started the year at 763,000. Now, what's going to be interesting is what happens these last couple of months. What happens these next couple of weeks leading into this November election? What happens around the holidays when typically you do get, a significant downturn on inventory before flattening out in January and then moving up into the spring? If we started 763,000 in 2020, that's before any of the COVID stuff kind of, changed the landscape forever. We're only at 734,000. We're only, 30,000 away from that number right as we sit here today. But we expect that number to decline, potentially even drop back into the sixes to start next year. But as we move into next year, we could really, get some gains if we move like we have this year, that get closer to even that 900,000, 1 million mark. In 2015, same time, same week in 2015, we're at 1.169 million. I mean, so we're still a long ways away from that. This currently right now is the inventory peak for the year. The peaks historically would come in, July, August. So we're peaking later in the season on inventory than we have in other normal markets. So that's good news, that inventory is seemingly still going up. Now let's take a look at new listing data. We had a better week on new listings than each of the last 2 years, same week. We had 60,600 plus on new listings, where each of the last 2 years, same week, we just saw 58,000. So that's been the trend here now for quite a few weeks, about 4 or 5 weeks, going all the way back into September, the beginning of September, all of September, and now the first week in October. We have beat the previous 2 years on new listings. So despite coming into a slower season, despite there being the election and all of this, we're seeing more new listings than the same time in the last 2 years for 5 straight weeks now. Now, remember, last year was all-time low for new listings, so it's not a huge win to beat that number. We expect to beat that number, and the good news is we are beating that number. Price cuts right now coming in for the week at 39.5%, a little higher than last year at 38%, but lower than 2022 at 42%. These price cuts have seemed to flatten out, bouncing around that 40% line, since late summer, even since August. That number's really flattened out. So price cuts not moving up. There was some expectation that maybe they could as inventory sat. That hasn't been the case. Total homes in contract sales, so pending sales right now, we have 8.6% more single family homes in contract than last year. And in fact, we have about the same amount that we saw in 2022. So 8.6% more homes under contract than the same time last year. That gap started to get wider when you compare to last year. That's another good sign for the market. And now, even with 2022, essentially, here are the numbers for the last 3 years, same week: 354,000, almost 355 right now, just about 326,500 plus last year, and 300, almost 59,000 for the same week in 2022 on pending sales. Mortgage purchase application. This is one we talked about last week and that I'm really excited about, because we're seeing purchase applications now year over year for the first time in 2 3/4 years actually be an improvement, right? Last week we saw it was up 8% year over year for the same week on mortgage purchase application. Now it's going to be really interesting this week to see what happens with mortgage purchase application because of what we're seeing on Friday. So I'm going to shift over to jobs now, and the unemployment number came in at 4.1%. Okay, so that is a little change there from 4.2, and now at 4.1. And the non-farm payroll employment increased by 254,000 for the month of September. Now, that number is significantly higher than what was projected. Okay, what happened when this news came out on Friday was the 10-year went up all the way to 3.9. Okay, 10-year at 3.9. I predicted on Knowledge Brokers, I'm like, we're looking at 6.5 when the 30-year fix closes out. And that's exactly what happened to end the week last week, 6.53. Okay, here is Friday. That one line right there, that is just Friday. That is just jobs report. That's all that is, this jobs report. So going straight up on the news that the economy and the jobs are coming in stronger, that Jerome Powell might be able to do a soft landing and be able to celebrate, one of the greatest accomplishments a Fed chairman ever has. That being said, how do we really actually trust the numbers coming out on this jobs? Remember, we had to just revise downward 800 plus thousand when we did the year over year review. We've also seen month over month revisions that actually put that miss up over 1 million on jobs. But the market reacts to the data that it has. So this data might be inflation. Government, again, was one of the top 2 employers. This, information might be inflated. It might be inaccurate, not saying that there's some conspiracy around it, but we've seen 12 months of inaccurate job data, but the market reacts to the data that it has in front of it. And that's what happened on Friday, and that pushed that 30-year fix up. One of the reasons why I thought it was so important before Jerome Powell cut to say to buyers, and I'm going to bring this chart back up. I just noticed I messed up the dates there. I want to fix that. But I'm going to bring up the 30-year fixed and, rehash what we talked about right before Jerome Powell cut. Okay, before Jerome Powell cut, I thought it was important to, let me get the MBA and the Freddie Mac out of here, and we'll just go with Mortgage News Daily's 30-year fix, just this blue line. Okay, that the last time we got down to the lowest point that we've seen since February 2023. We're down all the way to 5.99 in February of 2023. That just 30 days later, we were back up to 7.1% on March 2nd, 2023. Right? If you look at just this past October, we were at 8%. Just in August 30th, we were at 7%. So another full, percent. And you show a buyer or a seller who's thinking about buying and waiting for rates or whatever the case may be, that lock-in effect, right? Which we're going to talk about here in just a second. You show that prospective client, like, these shifts happen and they happen quick. So when you're down in this range, when you're down where we were right before Jerome Powell cut at 6.11 for a day on September 11th, and you had a few days right around that after, you take advantage of these because there are pops that can happen right after with new data, with new information that comes out. And it's important to take advantage of those moments in time. It's important to reach out to everybody who's, interest rate dependent during those moments, because then when 2 weeks later you're saying, hey, we've seen over the last 2.5 years moments when we've hit these lows and the rate's gone up a full point. When it happens like it's happening right now, you build more trust. Wow, man, he was right. Like, you're not predicting the future. You're not saying, hey, I predict that this is going to go up 1%. Hey, over the last 2.5 years, when we've hit these lows, here are 3 examples where it's gone from 5.99 to over 7%, where it's gone from 6%, 6.5% to 8% in just a matter of weeks. Not saying that that's going to happen now, but what I am saying is that 6.11, we can get everything that we want, everything that we've been talking about at the price point that we want, and we should take advantage at a time of year when negotiating is in our favor as a buyer. So monster jobs reports impacted even the way the CME group is thinking about the next Fed cut. Okay. CME group now has an 87.5% chance that the Fed does nothing, that the Fed does absolutely, 87.4% chance that the Fed does something, a 1/4 point cut. Okay. I'm sorry. A 1/4 point cut, but a 12.6% chance that the Fed does nothing. Okay. Right now we're at 4.75 to 5, 12.6% chance that CMA group says, hey, Fed comes in on November meeting and does no cut. 87.4% chance that they have a 1/4 point. So a 1/2 point cut is at 0% chance. 1/2 point according to CME group, 0, nada. Before we were debating, is it going to be another 1/2 or is it going to be a 1/4? CME group has been this changes. They change like the wind for sure. But as you get closer, it gets pretty accurate, and they've been accurate on like if there's going to be a cut or not. And so right now they're uncertain if there will be a cut. Okay, so that'll be up for obviously debate all of October as we go into November. Another thing up for debate, obviously this winter, is when will the lock-in effect actually start to thaw out? When are we going to be able to get back to a fluid market? 3.86 million existing home sales on an annualized rate is just not enough for a working market for a population of well over 330 million. And it's below the floor of what anybody thought we could get to. Well, Realtor.com released this bit of data that the mortgage lock-in effect is showing signs of easing as these new listings increase. We just looked at the year over year for the last 3 years on new listings. This week was better, albeit a small increase, an increase. Okay. The September housing report from Realtor.com says newly listed homes increased by 11.6% compared to last September. So Realtor.com seeing a much more significant bump than maybe that Altos research data is revealing on a weekly basis when you combine all of September. Okay. This is a significant reversal, they say, in the 0.9% decrease in August, while actively listed homes rose 34%. Here are the Realtor.com September 2004 housing metrics. Okay. Median listing homes down -1%. This is year-over-year change from September 2023. If you look at the change since 2019, it's up 36%, but a cooling off on median listing price. The listing price is coming down. Okay, that's different from actual sales price, but the listing price is a leading indicator of what's coming. Active listings up 34%. Okay, that's in line with Altos research, which I think had it at 36, 37% on active inventory. Okay, new listings up 11.6% for the month again. Median days on market is +7 days in September, up to 55 days. 55 days gets into buyer market territory. Plus 0.5% percentage points to 18.4%. That's a share of listings with price reduction. So price reductions moving up, days on market moving up, new listings moving up, active listings moving up, median list price moving down. Median list price per square foot up 2.3%. Okay, so why does Realtor.com state that we are chiseling away at the lock-in effect? We know what we've been dealing with the last couple of years. And mid-2024, 84% of mortgages had a rate below 6%. Okay, that's 84% of mortgages. We know that 40% of homeowners don't have a mortgage. Okay, and 56% still had a rate below 4%. The number though is actually this number is going to increase over 6% from 16% over the next quarter. So be on the lookout for that. But here are some of the metros with the highest new listings, which would thaw out some of this lock-in effect, getting this inventory onto the market. Seattle, 41.8% change in new listings. San Jose, 27% up. Washington, 26% up. Denver, 25. Boston, 24. Raleigh, 24. Los Angeles, 22. San Diego, 21. Providence, 21%. And then Richmond coming in at 20%. Also, the slowest September, says Realtor.com, since 2019. I just got off a text group with Tom and Lisa, and Tom Toole said, Tom and Lisa, who I do the Knowledge Brokers Pod with, Tom Toole said, man, September was slow. Glad we had a great first week in October. Just like the 30-year fix is volatile, I know a lot of businesses are volatile right now. It's like you got a good week and then a slow week, a good week. We don't have consistency right now. It's creating a very spotty market. And so September, according to Realtor.com, typical home spent the 55 days on the market, which we mentioned, was 7 days more than last year and 2 days more than August. So trending to be longer on the market here through this summer. Here's some of the charts that we'll have inside of BAMX. Again, if you're a BAMX member, be expecting a huge announcement from Zudilio that's benefiting all BAMX members. BAMX members, you also get special discount to BAM Mania. If you haven't gotten your ticket, go to bammania.com or reach out to Jill at nowbam.com for that. But all of these charts will be available for you inside of BAMX, like the active listing count, which shows a significant increase this year from any time the last 4 years, but still well below 2017, 18, and 19 models. Obviously, we covered that from the Altos research perspective, and that chart looks basically identical. Here's total listing count, up 22% in year over year in September 2024, and now we're going to cross over 2020 numbers here, probably any week on total listing. Pending listings showing an improvement over last year, but still well off of, look at obviously 20 and 21, but even well off of 22 according to this Realtor.com data. So we'll have all of that available for you inside of BAMX, so you can grab that and use that for your communications with your database, whether it be buyers, sellers, or investors. Again, 10-year unchanged from the start of the show, still up over 4%. 30-year fixed close out over 6.5 to end the week. Last week, we'll be looking to see where that goes here today, and I will be back with you tomorrow on another hot sheet, 9:30 live on the East, 6:30 on the West. You know the deal in between. Until then, go grab your ticket for BAM Mania, and of course, toodaloo.